Mentions of dollar debasement in news headlines have just surged to their highest levels in 5 years. The last time these words dominated headlines was back in 2020 and 2021. That period was followed by one of the sharpest drops in the dollar's purchasing power, the highest inflation spike in decades, and a notable economic slowdown in 2022. So worries about the dollar rapidly losing value are now building once again. But to understand whether those concerns are justified, we need to look at the main force that can weaken the dollar: how much new money the government is creating. And this chart shows just that. When the line rises, it means money is being created at a faster pace. When it falls, money creation is slowing. And when it drops below zero, it means the amount of money actually circulating in the economy is shrinking. Under normal conditions, money supply grows gradually, usually around 5% per year, which is just enough to support economic growth. But concerns about debasement begin when that growth suddenly surges. And if we look closely, there's a very clear pattern behind those spikes. In 2002, money supply growth spiked above 10% after the dot-com bust. In 2009, it surged again after the financial crisis. And especially after the pandemic, the growth rate spiked to more than 25% in a single year, something the US had never seen before. In each case, the government stepped in to stop an economic downturn from getting worse by printing money and injecting it into the system. More money circulating means banks have more to lend, households and businesses can borrow more easily, and the government can send stimulus directly to consumers, all of which boosts spending and keeps the economy from stalling. But while printing money works in the short run, it usually leaves a bigger problem behind. Every major spike in money supply growth has been followed by a more rapid drop in the dollar's purchasing power, like here in 2002, 2009, and again in 2021-2022. That's because when dollars flood into the system, each dollar becomes worth a little less. And when that happens, everything from groceries to rent becomes more expensive. People feel poorer, they spend less, and the economy slows. It's a cycle where the short-term solution ends up creating long-term pressure.